Today we are taking just the introduction to financial management, which is one paper in group 2 of CMA Inter. Okay, so mm, so financial management. What is financial management? You're able to see the screen, right?
Yes, ma'am.
Okay.
Yes, yes.
So, what is financial management? Put it in simple terms, it has two aspects to it: finance and management. Now, what is finance? Finance deals with your money, anything connected to your money, decisions relating to your money, that is finance. So, finance can be regarded as a science of money. He deals with money and all the monetary aspects of a business. So, what is financial management? It is finance plus management. So, that is managing the money in the business, managing your money. It can be regarded as financial management. Okay. So, I'll give you a very small example as to what all will be included in finance. Finance is not just cash, it is more than cash, and your financial decisions are a lot more than just handling your cash. So, where does your financial decision start from? What is the starting point? We'll take the example of a textile industry. Okay. So I am having a textile shop. Okay. Now, the beginning of my financial year, that is April, I'll take it 2023. Okay, the beginning of my financial year, what will be the first thing that I will do? I will be setting up a budget. So, the starting of any business is your budget or budgeting. We will budget what will be our prospective sales, and for the sales, what is the expenditure involved. So, how will I budget my sales? It will be based on my previous financial year. So I'll take my previous financial year's financials. I will see what is the sales. I might have had a sales of close to 900 crores. So now this year I will be planning, I have to have a sale of 1000 crores. So I am planning a 1000 crore turnover. So this is what is my budget or my prospective forecast of sales in the coming year. And for this turnover, I will budget all the expenses as well. Like what are the areas of expenses? I will need marketing, then purchases, then I'll require a go down. So what will be the expense of warehousing expenses? What will be the sourcing expenses? And how am I going to reach the turnover of 1000 crores? I'm having a textile shop. I can have two different ways of operation. Either I can buy materials, dresses, shirts from a wholesaler and then sell it, or I can have my in-house designing team. I can have a fashion designer and a set of tailors who will design and make custom made products based on the demand. Whatever is the demand in the market, they will customize the products and then we can sell it. So there are two different ways I can achieve this 1000 crore turnover. So that decision will be included in budgeting. How am I going to go about with my target of achieving 1000 crores? Now, after budgeting, what we will do? We have decided that this is 1000 crores. I have to attain a turnover. So, for that, I will need an X number of sales to be made. Now, to make the sales, to achieve this 1000 crores of turnover, I need money. So, I'll have to make a financial forecast. So here we made an overall budget of the expected turnover and the expected sales to be made. It will be, the budget will be more of quantity based. This is the sales, this number of units I have to sell to reach this turnover. So the next one is a financial forecast, where to sell so many units of clothes, what will be the finance that I will need. Again, this will go back to your basic decision. If it is buy and sell, it will be a different method altogether. That is, I am buying from an wholesaler, it is a trading activity, so I need more of working capital. Whereas if it is to customize the products and then sell it, I need a proper full manufacturing setup installed. So there will be rental expenses. I will need machinery installed. So these are all long term in nature. So long term expenses are there. Whereas in case of buying and selling, there is more of working capital requirement. Because I need to pay my wholesalers immediately and then sell the product. Whereas when I am customizing, I need machinery, setup, and a rental space. So all these are long term in nature. So it is a long term expenses. So the financial forecast will depend on your budgeting and the decisions that we are making in our budget as to how to reach our turnover, how to reach the targets. So that is called as financial forecast. So first quantity wise we are budgeting, then we are making a financial forecast. After making financial forecast, what we'll have to do? We have made the forecast. Now we know that so much amount of working capital is required. So for 1000 crore turnover, I will need at least 100 crores as working capital. I have made a decision, and then I need some investment in fixed assets and other long term investments, which will be some 50 crores. So, this I have made a forecast. Now, I need to raise funds. So, the next step is raising of funds. Raising, it is not just raising of and control of funds. When we reach the raising and control of funds place, that is where we decide how to raise funds. There are again different ways in which we can raise funds. I can either borrow from bank, or we can borrow from other non-banking financial institutions, or we can sell a part of the business to somebody else, make someone else the a 10% ownership share, we can sell off and raise funds. So there are different ways in which funds can be raised. So when we come to raising of funds, we need to decide how to raise funds in such a way that the total cost involved in raising of funds is minimized. I'll tell that in detail when we go to the next section. So here we are deciding on how to raise funds, whether we should go with debt or with equity. Okay, this decision we have to make. And we should also control the funds that we have raised. When we have raised the funds, if we feel that in the financial forecasting we have made a forecast for marketing expenses some 50 lakhs, but when we are raising funds we feel that the for 50 lakhs if I take a debt, my return is not going to be enough, the cost of debt is too high, then I will control the funds in this place. I'll decide that I'll go back and decide that okay, 50 lakhs we cannot raise for marketing. We'll make it 30 lakhs for marketing and raise it through debt. Okay. Am I clear till now? If there is any, if you want me to explain once more, you can just tell me. Okay. So I have budgeted the quantity, then we have made a financial forecast, and then based on the forecast and the budgets, we have decided to raise funds, and how to raise funds also we have decided. So now we have raised the funds, we have money also to go ahead with our business. We are doing the business, we are selling. I am going with this concept of buying and selling, which I feel that it is more cheaper. So I'm buying from the wholesaler, and I've made the sales also. I have earned some 500 crores turnover as of now. Now when I'm earning money, there are two ways in which you can earn money: cash, credit, right? So there will be cash sales as well as credit sales. Now when it is cash sales, out of this 500, okay, assuming 200 is cash sale and 300 is credit sale. Now I have 200 crore of cash in hand, okay, in my bank and in my hand put together. There is 200 crores. What will I do with this 200 crores? So that is where we need to make a cash administration and investment decision. Okay. First thing, 200 crores, I have to administer the cash properly. I have to ensure that it is properly available and there is no pilferage, there is no theft, nothing. It is properly available. It is there in the bank. I have to ensure that the bank is properly reconciled and I have enough cash in hand. As per the books, I have the cash in my bank and cash in hand also. Then this 200 crores of cash, out of 200 crores, I might need only 100 crores as working capital. So what will I do with the balance 100 crores? Working capital, I guess you know what is working capital. I'll just explain it also. Working capital is current asset minus your current liability. It is the cash that is required for the day-to-day working of the business. In case of a textile industry, I will be having 100 shopkeepers in the shop. Textile shop we are taking, so I'll have 100 shopkeepers in the shop. So for the shopkeepers, I am paying them daily wages. In that case, on a daily basis, I should have enough cash in my bank and hand put together to meet their daily wages. Okay, then go down from the go down to my shop. Daily there will be trucks coming in. Okay, I need to pay the loading unloading charges on a daily basis, right? So to meet all those daily expenses, we need to have liquid cash. By liquid cash, I mean cash in your hand as well as in the bank. So that liquid cash is required. So that is called as working capital. So my liquid cash requirement, I am assuming it to be only 100 crores, whereas from the current sales I have got 200 crores. So we have to make an investment decision there. The balance 100 crores, there are two ways in which you can invest. You can invest in short term FDs, short term deposits of like 2 months or 3 months, okay? Or you can go for a long term investment, buying assets, okay? Buying a building, buying a land, or going for long term assets like long term FDs. So there are different long term and short term options of investment available. Again, that is an investment decision that the businessman has to make. At that point, he has to say, okay, I have 100, I need only 100 crores, I have an extra 100 crores in hand. But my total sales as of now is only 500 crores, okay, out of which 300 is credit. 2 months down the line, if I invest this 100 crores in long term asset or a long term, put it in a long term FD, I am not going to get this 100 crores for another 1 or 2 years. But my working capital, as of now, it is sufficient. But 2 months down the line, I might not have enough cash if my credit does not get realized in 30 days or 60 days. If the creditors don't pay me in 30 days, what will happen? I am left with no cash. So, we have to make a decision based on the situation whether to invest in a short term FTs, short term asset, or whether to invest in long term asset. Then we come to credit. Now, credit sales, when we give credit sales, you can see you can give credit for 30 days, 60 days credit, 90 days credit. There are different uh, credit options available. Now, it is for the businessman to choose which credit option will best suit him. Okay. Suppose my purchaser, the wholesaler from whom I am purchasing the textile, he is giving me a 30 days credit. Okay. So this 300 crores of worth product I have got on a 30-day credit. Now if I make sales for 60 days credit, what will happen? I have to pay my wholesaler within 30 days 300 crores. But the person to whom my customer is going to pay me that 300 crores only after 60 days. So I have to pay out of my pocket now, right? That will affect my working capital. I have only 100 crores as working capital that I have kept aside. From where will I pay him 300 crores? So that credit decision, the credit administration decision also we have to take before when we give the credit. So all of this are interrelated. I'll just write it a bit neatly for you. So we saw first one was budgeting. The second one was financial forecasting. Okay. After forecasting, we decided on sources of fund and controlling the fund. Okay. Then it was cash administration. Then we did an investment decision. Then the last one was your credit administration. Okay. All this put together is financial management. Okay. So financial management is not just money, just cash. It involves end-to-end decision making to ensure that your maximize your return and minimize your cost of capital. Okay, so that is maximize your return to your to the owners of the business and minimize the cost. That is the ultimate role of financial management. Am I clear till this?
Yes.
Yeah. Okay. Somebody else has joined. Yeah. Okay. Now next we'll see what are the objectives and functions of financial management. Okay. There are two objectives of financial management. Profit maximization and Wealth maximization, wealth or value. Okay. Profit, very simple. It is the net of your revenue minus your sales. Revenue minus your cost. That is your profit. Okay. This way you will see in your P&L account what is the last line in your P&L account. It gives you the net profit and profit after taxes and all of that. But what is wealth or value? What is the difference between profit and wealth or price and value? A simple example, a business is having a loss. Okay, it is running in loss. Now, why it is running in loss is because of poor management. Okay, this is why. This is the answer for your why. It is because of poor management. The directors are not working properly. There is poor management. They are not interested in the company, because of which the business is running in loss. But it is having a huge asset base, a lot of buildings, a lot of machinery, and a good amount of land. All huge asset investments are there, and it is having a very trained workforce. Now, if this business is available for sale, okay, a buyer might not just see this loss. A buyer might be interested in buying this business. Why? Why? Because he sees that the net worth of the business is more than this profit or the loss or the profit. There is huge asset, there is a good trained workforce. If I have to start a business from scratch and train my workforce, it will take 10 years for me to reach where he is now. The business is running in loss only because of poor management. So if I am buying this business and I'm changing the management, I'm putting a good management, a good staff at the top, then I will be able to reap the benefits, and this loss I can make it into profit. So I will be willing to buy the business for a value even though it is running in loss. So that is the difference between profit and value. For example, you can see there are many companies whose shares are still running at a good value even though their financials are showing a loss. For example, we have ITI, which is running in loss, but then it is having a good share value. Zomato, okay, these are, they are actually their financials, if you see, they will be showing a loss, but still in the market they are their shares are being traded for a value because of the opportunities involved, because of the assets they are having, because of the workforce, the kind of business structure, business model that they have innovated. Because of that, they will have a value. So that is value maximization or wealth maximization. That is also one of the objectives of financial management. It is not just to increase the profit in the books, but to increase the worth of the business. Okay, there are two terminologies that you have to know here. Net worth. Net worth of a business means assets minus your outside liabilities. Okay, this is called as the net worth of the business. And another one is value of a firm or value of a business is equal to market value of equity plus market value of debt minus cash. Okay, these two terminologies you should remember. Value is nothing but the worth of the business, the worth. And what is worth? It is assets minus outside liabilities, or in case of a traded company whose shares are listed, it will be market value of equity plus market value of debt minus the cash in hand and bank. Now, what is market value of equity? Market value of equity is the market price at which the shares are traded into the number of shares. That will be the market value of equity. Now, after objects, we'll come to functions. Functions of financial management. It is the same thing that we discussed with the textile example. The only thing is now we will be seeing from the perspective of a corporate. From corporate perspective, what will be the functions? It is more or less similar to the same thing that we discussed for a small textile shop. We have three decisions that we will make: investment decision, okay, and we will have financing decision, we will have dividend decision. Dividend decision because it's a corporate and they pay dividend. Investment decision, what are the two decisions that we will be having? One is the long term and short term, right? So the long term investment decision is called as capital budgeting, and the short term investment decision is called as working capital management. Now, capital budgeting, what is capital budgeting? It is to decide where to invest. When I told you that you have enough cash in hand, you have two investment options, long term and short term. Long term itself, there are different options available, right? You can invest in shares, you can invest in bonds, you can invest in your own business, you can invest in somebody else's business, right? So all these kind of investment decisions we will be making based on the on capital budgeting. We can also decide on our own investment in our own business. When we are investing, we can invest either in asset purchase, or we can start up a new branch, or we can expand in a new market, right? All these are also long term decisions that involves investment. So we, how we will take the decision, we will see what is the risk involved in each of the investment option, what is the return that we are going to get from each of the investment option, and what is the cost of investment. Based on these three options, we'll decide which is the best one. Okay, like if I am going to invest in a new market, the risk involved is very high. Okay, similarly the return will also be very high if it goes through. If I am going to invest in an FD, the risk involved is minimal, the return is also minimal. I'll get hardly 7 to 8% return. Whereas if I am going to a new market and if it works, I might get 40 to 50% as profit. So that decision we have to make based on the investment options that we have in hand, the amount of risk that is there, the probability of return, how sure we are about the new market, and whether we'll be able to earn a profit or not. So that is capital budgeting decision. Working capital management, again for short term also we have different options in which we can invest in. We can have short term FDs, then we can have T-bills. T-bills are called as treasury bills, which is again government related, or we can go for non-government short-term investments as well. Okay, investment in other business. So again, this we have to decide based on the risk return probability options. Then financing. Financing, when we are going to raise funds, how will we finance a project? It will be based on cost of capital. The second one is capital structure. The third one is leverage. Now, what are these three terminologies? Cost of capital is the cost of raising a fund. I am borrowing 1,000 rupees from bank. at an interest rate of 10%. Now the cost of capital is 10% or 10 rupees. Okay. I am preference shares. I am raising funds through preference shares at 9% dividend. So what will be the cost of capital? It will be 9 rupees or 9%. That is called as the cost of capital. So different structures, different sources of funds, we will define what is the cost of capital for each source of fund before making a decision. So if I have this decision, we will either go by preference shares, which is at 9%, rather than going for a bank loan at 10%. Now, capital structure is a combination of debt and equity. We should always have a balance of debt and equity. What will happen if there is too much of debt? If there is too much of debt, there is a 100% mandatory commitment on our side to pay interest. So, what is the requirement of our working capital? Our working capital requirement increases because we have to meet our interest requirements. If it is on a monthly basis, if we have to pay interest on a monthly basis, monthly we need to have so much of amount. So, if I am raising 1,000 crores from through debt, what will be my interest amount? It will be very huge. So, the working capital also I need to keep that much of working capital. So, when I am keeping that much of working capital, my investment options are reducing. Okay, so there should always be a balance between debt and equity. If equity is increasing, if I'm going only by equity and I'm saying okay, I will not touch debt itself, debt is a trouble for me, and if I go with only equity, number of shareholders will increase. Number of shareholders increases, the return for each person reduces. So when return is very less, will the shareholders be interested in investing more? They will not be interested in investing more. So there should always be a balance between debt and equity. Then we'll come with the term leverage. Leverage, two types of leverages are there. One is operating leverage and one is financial leverage. This again I'll explain with a simple example of the textile shop itself. Okay, textile shop, my turnover target is 1,000 crores. So I am assuming I have to sell at least 1 crore of textile. Okay, to attain this profit, assuming. So I have a go down or a warehouse. Okay, warehouse where I can store 1 crore of textile. Okay, but because of some unforeseen circumstances, I was able to use the go down only 50%. So I could store only 50 lakh of textile there. Okay, so I, even if I store 1 crore or I store 50 lakh of textile, I need to pay the go down owner the same amount of rent, assuming the rent is 50 lakhs. Sorry, we'll put it 5 lakhs. Assuming the rent is 5 lakhs per month, I have to pay this 5 lakhs irrespective of the utilization of the go down. Okay, so even if I store just one textile, one dress, I need to pay him the same 5 lakh. So operating leverage means maximizing the utilization of all fixed expenses so as to increase your profit. So instead of storing 50 lakh of material, I should aim at storing 1 crore of textiles in order to ensure that I am using my fixed cost expenses to the maximum, thus ensuring an operating leverage. So, operating leverage is nothing but ensuring all your fixed expenses, fixed cost is utilized to its maximum capacity, thereby increasing your revenue and profit. Now, what is financial leverage? Financial leverage is interest. Okay. Interest is a tax deductible expense. You might have seen in the P&L, interest comes before profit. It is a tax deductible expenses. Whereas dividend comes after profit, after tax, after PAT. Only the dividend is mentioned. Dividend is not a tax deductible expense, whereas interest is a tax deductible expense. So financial leverage means using more of debt funds so that you can maximize the benefit of tax advantage. That is financial leverage. So, when we make a financing decision, we need to take into consideration the cost of capital. We need to ensure there is a proper balance of debt and equity such that there is a financial leverage attained. We are able to use the debt and the interest to the maximum advantage to get the tax benefit. Then dividend decisions. Dividend decisions simple whether to pay or to retain. This decision we have to take whether to pay. If we see that there is enough of profit available in the books, we will be able to pay the shareholders. We should pay the shareholders. Or if there are a lot of opportunities available in future for expansion, we would rather retain the dividend, right? So this is the functions of financial management in a corporate setup. It is more or less similar to an unorganized setup. Only thing is it is more clearly given. Am I clear till now? Do you want me to explain any topic once more? Okay, so shall I go to the next topic?
Yes, ma'am.
So till now, what did we see? We saw what is financial management. Financial management is nothing but just managing your finances from the point of budgeting to the point of receiving cash, investment, and credit management. Entire thing is covered under financial management. And the main aim of financial management, two important aims: profit maximization, that is increasing your return, and wealth maximization, that is increasing the net worth of the company by making the correct investment decisions, the correct financing decisions, and the correct dividend decisions. Okay, now all these decisions, when we are saying we have to make the decision, cost of capital decision, this decision, that decision, everything is based upon one factor. What is that? That is money, right? Where should I invest the money? How should I raise the money? And whether I should pay or retain, everything is dependent upon money. And what is the value of money? The value of money is time. Okay, time is the most important thing that determines the value of money. Okay, if I have 1 lakh today, you might have 1 lakh 2 days later. Which is more valuable today? Today, I am more valuable because I have that 1 lakh of money in my hand today compared to you who might have 1 lakh 2 days later, right? So the time is the most important factor that determines value, that gives value to money. So now we will come to the concept of time value of money. You might have heard of this proverb, a bird in hand is worth more than two in bushes, right? This that proverb is very much correct, and it is perfect for money. Money in hand is worth what you will get or you might get later. If somebody is telling you, I will give you 1 lakh salary today, and someone else is coming and telling you, I'll give you 1 lakh and 10,000 salary maybe 1 year later, what will you choose? You will choose the one that is more probable of happening. Okay, he's telling me he will give me a job with 1 lakh salary today. I don't know about the other person. He, as of now, he's telling he'll give me a job with 1.1 lakh salary after 1 year. But I don't know after 1 year what will happen. There is so much of risk involved. It is the future is a lot of unforeseen future. So, and hence what I will do, I'll go with the current option. The current option is better. At least I am sure that he is going to give me a salary of 1 lakh from this month if I join his company, right? So that is the simple logic of time value of money. Money today is worth more than money tomorrow. Another example, you have done a project for one company, okay, and the company is telling you, I will not and the rate fixed is 1 lakh for that project, okay. The company is telling you, I will not pay you 1 lakh this month, I will pay you 1 lakh 3 months later. I'll pay you 1 lakh. Now, what will be your decision? Will you tell, okay, it is just 3 months, what is there? Let him pay me the same 1 lakh after 3 months. Is it the right decision? Now, we will see whether it is the right decision or not. 1 lakh, if you get today, you can put it in a simple FD. Okay, FD for 3 months. 3 months, you assume the rate to be 3%. At the end of 3 months, it will be 1 lakh plus 3,000. It will be 1 lakh 3,000. But he is telling you after 3 months, he will pay you 1 lakh. Whether it is correct? No. You are losing out, right? So, what you will, today's 1 lakh is more worth than 1 lakh 3 months later, because there is a value for time, and the value for the time is this 3%. It is the opportunity cost that you are having. Instead of letting him to pay 3 months later, that 1 lakh if I had got today, I would have invested in an FD, simple FD. I'll get 3% for 3 months. I'm getting 1 lakh 3,000 at the end of 3 months. So my suggestion to that person will be, you pay me 1 lakh 3,000 at the end of 3 months. At least give me the FD interest, right? So that is what is called as time value of money. Now, how to calculate this time value of money? I'll just give you one more example here of a house property as well. House property. You're buying a house, okay, with an investment of 40 lakhs today. Your assumption is I will let this house out, I will rent it out for 10 years at 10,000 rupees. So it is 10,000 for 12 into 10. So it is 120, 2, 3, 4. So it is 12 lakhs. I'll get 12 lakhs. And then at the end of 10th year, I will sell the house for like 30 lakhs. After, because it will get depreciated, I will sell it at 30 lakhs. I will get 42 lakhs. What do you think? 42 lakhs. Now it is 40 lakhs. I will get 42 lakhs at the end of 10 years. I've made a profit of 2 lakhs. Is it correct? Have you really made a profit of 2 lakhs at the end of 10 years? Now the question is, this 40 lakhs, if instead of buying a house, if you had invested in a simple FD, risk free FD, what will be the return after 10 years? Right? It might be more than 42 lakhs. Then is the investment decision correct? Then the investment decision is wrong. This 42 lakhs, when you see it at today's value, it might be less than 40 lakhs. So this 40 lakhs, yeah, is your present value. 42 lakhs is your future value. This is in 2024. This is 2034. This 2034's value, you have to bring it as on 2024. What is the worth of 42 lakhs today in 2024? Then only you can compare and find out whether you are earning a profit or not. Because today's 40 lakhs will not be same in 2034, and 2034's 42 lakhs will not have the same value as that of 42 lakhs in 2024. The time involved need to be considered to arrive at the actual value. So 2034's 42 lakhs need to be brought to 2024's, as on 2024, what is the value we need to arrive? Then only we can make an investment decision. Now this process of arriving at the present value of 42 lakhs. From 42, you are arriving at the present value as on 24. That process is called as discounting. You are discounting your future value to arrive at the present value of that 42 lakhs today. What is the present value of this 42 lakhs today? That process is called as discounting. And what is the future value of 40 lakhs in 2034? Arriving at that process is called as compounding. So compounding is arriving future value from present value. and discounting is arriving at present value from future value. So if any of the values are given, we will be able to arrive at the future value and present value. Now how to arrive? There is that. Again, I'll explain with an example. Okay, I have an FD of 1000 rupees. Okay, rate of interest is 10% and number of years 3 years. I put an FD for 3 years. Today. So today's value is, this is present value. Today's value of the FD is 1000 rupees. So in 3 years later, what will be the value of that FD? 1000 rupees. First year 1, 10% interest is getting added. So 110, it will be 0, 1, 1, 1, right? Then year 2, again 10%. Okay, 1, 2, 2, 1. Year 3, 122, correct? So it is 3, 4, 3, 1, right? I guess somewhere this is 100. Yeah. So it is 1100, 110, 0, 1, 3, sorry, 121 and 121. It will be 1331. Yeah. Okay. It was just a calculation error. So at the end of year 3, my future value is 1331. So 1000 rupees, if I invest in an FD today, I will get 1331 in 3 years later. So my future value of an of 1000 rupees 3 years later is 1331. This is present value and this is future value. There is a formula to calculate this. Present value is future value. We are discounting it. So we divide it by 1 plus your rate of interest raised to number of years. And future value, we will be compounding the present value. So present value into 1 plus rate of interest into n. So what does this say? My present value multiplied by 1 plus r. 1 plus r is this here. What is this? This is 1.10, right? 1 plus r. So principal plus your rate of interest raised to the number of years. So this for 3 years, I have to multiply my present value with the rate of interest. If I do that, so this is 1.10 here. Then we have 1210 is again 1.10. Then here this is 1.10. So 3 times 1.10. So my principal is doubling by 10% for 3 times. Then I am arriving at my future value. So if I invest in an FD today, after 3 years, I am going to get this as my future value. With this house property for 10 years, if we assume it to be a 7% interest rate, 40 lakhs today, if we had put it in a simple FD, it will be 1 plus 7% raised to 10. That will be the answer. We'll just do it in Excel. So it is 40 lakhs into 1 plus 7% raised to 10. So had I invested it in, okay, one second. Yeah. So had I invested it in a simple FD of 7%, after 10 years I would have got approximately 78 lakhs. Okay, so but in this methodology, that in the house property investment, I am assuming it will be close to 42 lakhs only. So is this a good investment option? If I see at 2024 I am investing 40 lakhs, 2034 I am getting 42 lakhs, I it will sound like I have made a profit, but in real I have not made a profit. If I had chosen another investment option, I would have earned more than what I have invested in a house property. We'll just stop it at this. Uh, so do you have any doubt?